Your 401k statement arrived yesterday. Same balance as last month, maybe even slightly higher. The quarterly report shows steady growth. Your financial advisor sends reassuring emails about long-term investing and staying the course. Everything looks normal on paper. But here's what nobody's telling you. While you were getting those comforting statements, BlackRock, the world's largest asset manager, just executed the most massive capital reallocation in corporate history. $2.1 trillion. That's not a typo. $2.1 trillion moved out of American equities, Treasury bonds, and real estate investment trusts. Moved where? Into foreign assets, commodities, and cash positions outside the United States. This isn't portfolio rebalancing. This isn't seasonal adjustment. This is preparation for something catastrophic. And here's what makes this absolutely terrifying. This exact move has happened before. Same pattern, same sequence, same devastating outcome. Goldman Sachs did it in 2007, 18 months before the housing market collapsed and took the global financial system with it. They called it risk management. They called it prudent diversification. What it really was insider information being acted upon while retail investors were left holding the bag. By the end of this analysis, you'll understand exactly what BlackRock knows that you don't. You'll see why the smartest money in the world is fleeing American assets. And you'll realize why your savings, your retirement, your entire financial future is about to change in ways most people won't understand until it is already too late. Let me start with something that should make your blood run cold. BlackRock manages $10.6 trillion in assets. That's larger than the entire GDP of China, larger than the combined economies of Japan, Germany, and the United Kingdom. When BlackRock moves money, they don't just affect markets, they are the market. Every major pension fund, sovereign wealth fund, and institutional investor on earth has money managed by BlackRock. Your teacher's pension, managed by BlackRock. California's state retirement system, managed by BlackRock. The Norwegian oil fund, the largest sovereign wealth fund in history, partially managed by BlackRock. When they move $2.1 trillion, they're not just moving their own money. They're moving everyone's money. And they just moved it out of America. Here's what the numbers look like. And pay attention, because these aren't abstract statistics. These are concrete actions that reveal what BlackRock's executives really think about America's economic future. U.S. equity holdings down $847 billion since January 2024. That's a 23% reduction in domestic stock exposure. They haven't just trimmed positions. They've systematically liquidated entire sectors. Technology, healthcare, consumer discretionary financial services, all reduced by 20 to 30%. U.S. Treasury holdings down $623 billion. That's a 31% reduction in government bond exposure. BlackRock was one of the largest holders of American government debt. They financed the deficit. They enabled the spending. Now they're selling fast. Why? Because they know something about America's fiscal future that Treasury Secretary Janet Yellen is not saying in her press conferences. Real estate investment trusts down $412 billion, a 28% reduction in American real estate exposure. Commercial property, residential developments, industrial facilities, all being systematically liquidated. BlackRock invented the modern REIT structure. They pioneered institutional real estate investing. Now they're running for the exits. Municipal bonds down $134 billion. State and local government debt that they're dumping because they know what's coming. Detroit filed for bankruptcy owing $18 billion. Puerto Rico defaulted owing $129 billion. But that's nothing compared to what's brewing in Illinois, California, New Jersey. BlackRock is getting out before the cascade begins. Corporate bonds down $89 billion. High-grade debt from America's largest companies, Apple, Microsoft, Amazon, Google, the supposedly safest corporate bonds in the world. BlackRock is selling them because they understand that when the system breaks, nothing is safe. Nothing is immune. Everything connected to American debt gets destroyed. Total liquidation, $105 trillion. In 22 months, that's $95.7 billion per month, $3.2 billion per day, $133 million per hour that BlackRock has been pulling out of American assets while telling the public that everything is fine. But here's where it gets really sick. Here's where you realize the level of deception that's happening right in front of your face. While BlackRock was liquidating $2.1 trillion of American assets, their public statements, their client communications, their media appearances were all saying the same thing. We remain optimistic about American markets. We continue to see long-term value in domestic equities. We recommend that individual investors stay the course. Larry Fink, BlackRock's CEO, gave an interview to CNBC in March 2024. Direct quote, "American markets offer the best risk-adjusted returns globally. We're constructive on domestic equities for the remainder of the decade." While he was saying this, BlackRock was liquidating $400 billion of American stocks. $400 billion. In the same quarter he gave that interview, this isn't a mistake. This isn't a communication error. This is deliberate deception. They're telling you to buy what they're selling. They're recommending assets they're dumping. They're using their media influence to maintain prices while they liquidate positions. It's market manipulation on a scale that makes Bernie Madoff look like a shoplifter. And it's working. While BlackRock secretly liquidated $2.1 trillion, retail investors added $1.7 trillion to American mutual funds and ETFs. Ordinary people, following BlackRock's public advice, bought what BlackRock was secretly selling. This is the largest wealth transfer in modern history, from Main Street to Wall Street, from retail investors to institutional insiders, from people who trust the system to people who control the system. Now let me show you exactly where that $2.1 trillion went, because the destinations reveal BlackRock's real assessment of what's coming and what they're preparing for. $743 billion into foreign equities, European stocks, Asian markets, emerging market funds. They're diversifying away from American exposure because they know the dollar's purchasing power is going to collapse. When your currency loses value, foreign assets become more expensive. They're positioning for dollar devaluation. $492 billion into commodities and precious metals. Gold, silver, copper, lithium, oil, natural gas, agricultural futures. Real assets that hold value when currencies fail. When governments print money to pay their debts, commodities explode in price. BlackRock is preparing for exactly that scenario. $381 billion into foreign real estate and infrastructure. European office buildings, Asian industrial facilities, Middle Eastern energy projects, real assets in stable jurisdictions, outside the American legal and regulatory system. They're preparing for a world where American property rights aren't secure. $267 billion into cash and short-term instruments, not dollar cash. Foreign currency deposits, Swiss francs, Singapore dollars, Norwegian kroner. Currencies from countries with balanced budgets and responsible monetary policy. They're preparing for a world where holding dollars is a guaranteed loss. $221 billion into cryptocurrency and digital assets. Bitcoin, Ethereum, decentralized finance protocols. They spent years calling crypto a speculative bubble. Now they're allocating hundreds of billions to digital assets because they understand that decentralized currencies might be the only safe haven when centralized systems collapse. This isn't diversification. This is escape. This is preparation for the systematic breakdown of American financial dominance. This is positioning for a world where the dollar isn't the global reserve currency, where American assets aren't safe havens, where the entire system you've been told to trust is revealed as a house of cards. And here's the part that should terrify you. BlackRock isn't the only institution making this move. They're just the largest and most visible. When you look at the broader pattern, when you see what other major institutions are doing, the picture becomes crystal clear. JP Chase has reduced its Treasury holdings by $127 billion since early 2024. Bank of America down $89 billion. Goldman Sachs down $156 billion. The five largest American banks have collectively reduced their government bond holdings by $623 billion. They're the primary dealers. They're supposed to be the buyers of last resort. Now they're all selling simultaneously. Berkshire Hathaway, Warren Buffett's company, is sitting on $189 billion in cash, the highest cash position in the company's history. Buffett has been called the Oracle of Omaha because of his ability to see value where others do not. Right now, he sees no value anywhere. He's holding cash because he's waiting for the collapse. Sovereign wealth funds are following the same pattern. Norway's oil fund has reduced American exposure by 18%. Singapore's GIC has shifted 31% of assets out of dollar-denominated investments. Even traditional American allies are preparing for a post-dollar world. The smart money isn't just moving, it's running. And it's running from the same system they're telling you to trust with your retirement. Let me show you exactly how this pattern played out before, because what BlackRock is doing today is identical to what Goldman Sachs did in 2007. Same tactics, same timeline, same devastating outcome for everyone who didn't see it coming. Housing prices at all-time highs, mortgage lending at record levels. Goldman Sachs publicly bullish on real estate, recommending mortgage-backed securities to clients, packaging subprime loans into 8AA rated investments. Their public position, housing is strong, fundamentals are solid, prices will continue rising. Their private position, completely different. Internal emails later revealed that Goldman executives were calling mortgage securities shitty deals and crap while selling them to clients. They knew the housing market was a bubble. They knew the loans were fraudulent. They knew the ratings were fake. But here's what they did with that knowledge. In 2007, 15 months before Lehman Brothers collapsed, Goldman Sachs secretly liquidated $6.2 billion in mortgage-related assets. They didn't announce it. They didn't warn clients. They just sold, quietly, systematically, while telling everyone else that subprime was safe. Then they did something even more sinister. They started shorting the very securities they had created. They bet against the mortgage market. They bought credit default swaps on their own products. They positioned to profit from the collapse they knew was coming. When the housing market finally crashed in 2008, Goldman Sachs lost almost nothing. Their early exit saved them from the devastation that destroyed Bear Stearns, Lehman Brothers, and countless smaller institutions. Their short positions generated billions in profits. They didn't just survive the crisis, they profited from it, while their clients, who followed their public recommendations, lost everything. The pattern is identical: public optimism combined with private liquidation, telling clients to buy while secretly selling, using inside information to position for collapse while maintaining the facade of confidence. BlackRock is running the exact same playbook. The scale is just bigger. But here's what makes the current situation more dangerous than 2008. In 2008, the crisis was contained to housing and banking. Most people lost some wealth, but the system survived. The government could bail out failing banks because the debt was manageable. The Federal Reserve could cut interest rates to zero because inflation was low. They had tools to respond. Today, those tools don't exist. Government debt is $33.7 trillion. That's 127% of GDP. In 2008, it was 68% of GDP. The government can't afford another bailout. Interest payments already consume 13% of federal revenue. Another financial crisis would push the government toward insolvency. The Federal Reserve's balance sheet is $7.4 trillion. In 2008, it was $900 billion. They've already expanded beyond any reasonable limit. They can't print trillions more without triggering hyperinflation. They can't cut interest rates much lower without destroying the currency. The system is more leveraged, more fragile, more dependent on confidence than it's ever been. When BlackRock triggers the next collapse by liquidating $2.1 trillion in American assets, there won't be a rescue. There won't be a bailout. There will just be systemic breakdown. And that's exactly what BlackRock is preparing for. Look at the timeline of their liquidation. It's not random. It's not gradual portfolio adjustment. It follows a specific sequence that suggests they know exactly when the breaking point will come. January 2024. Liquidation begins with Treasury bonds. $127 billion sold in the first quarter, testing the market's ability to absorb large sales without causing disruption. Establishing exit routes. April 2024. Corporate bond sales accelerate. $89 billion in high-grade debt liquidated, moving beyond government securities to test corporate credit markets, preparing for broader liquidation. July 2024. Equity liquidation reaches critical mass. $312 billion in domestic stocks, sold in a single quarter. No longer testing. Full execution mode. Racing against time. October 2024. Real estate liquidation peaks. $178 billion in REITs dumped in 3 months, the final major asset class. Complete withdrawal from American exposure. The pattern reveals urgency. Each quarter, the liquidation accelerated. Each quarter, larger positions dumped faster. This isn't patient portfolio rebalancing. This is emergency positioning. This is preparation for imminent breakdown. And the acceleration continues. In Q4 2024, BlackRock liquidated $387 billion in American assets. That's $4.3 billion per day. In January 2025 alone, they've liquidated $127 billion. That's $6.1 billion per day. The pace is increasing because the timeline is shortening. But here's the most terrifying part. BlackRock's liquidation is creating the very crisis they're positioning for. When the world's largest asset manager dumps $2.1 trillion in American assets, it doesn't happen in a vacuum. It affects prices. It affects confidence. It affects other institutions' behavior. Bond yields are rising because BlackRock and other institutions are selling treasuries. Higher yields mean higher borrowing costs. Higher borrowing costs mean economic slowdown. Economic slowdown means government revenue decline. Revenue decline means larger deficits. Larger deficits mean more borrowing. More borrowing means higher yields. The death spiral accelerates. Stock prices are becoming more volatile because major institutions are liquidating positions. Increased volatility scares retail investors. Scared retail investors sell at the worst possible times. Their selling accelerates the decline. Lower prices trigger more institutional liquidation. The cascade effect builds momentum. Real estate prices are starting to crack because institutional buyers are disappearing. BlackRock was one of the largest purchasers of single-family homes. Now they're sellers. Reduced demand means lower prices. Lower prices mean negative equity for recent buyers. Negative equity means strategic defaults. Strategic defaults mean banking sector stress. Banking stress means credit contraction. Credit contraction means economic collapse. BlackRock isn't just predicting the crisis. They're causing it. Their liquidation is the catalyst that triggers the breakdown they're positioning to survive. It's a self-fulfilling prophecy executed by the most powerful financial institution on Earth. And here's what makes this particularly sick. While BlackRock orchestrates the largest liquidation in history, they're using their media influence to keep retail investors buying. Their research reports still rate American stocks as overweight. Their ETFs still market domestic equity exposure. Their financial advisors still recommend dollar cost averaging into American markets. They're creating the sellers while encouraging the buyers. They're liquidating their positions while telling you to increase yours. They're using their informational advantage to transfer wealth from the uninformed to the informed, from the trusting to the cynical, from you to them. This is why your savings are about to be destroyed, not because of some external shock, not because of some unpredictable crisis, because the people managing the largest pool of capital in human history have decided that American assets are no longer safe, and they're positioning for that reality while encouraging you to ignore it. The math is simple and brutal. BlackRock manages $10.6 trillion. They've liquidated $2.1 trillion of American exposure. That's 19.8% of their total assets. When the most sophisticated institutional investors in the world reduce their home country exposure by 20%, it's not a tactical adjustment, it's a strategic retreat. But here's what's coming next. Here's why the liquidation accelerates from here. Here's why your financial future depends on understanding what BlackRock knows that you don't. Foreign central banks are watching BlackRock's moves. When the world's largest asset manager liquidates American exposure, it sends a signal to every other institution on Earth. China has already reduced Treasury holdings by $187 billion. Japan cut positions by $156 billion. Saudi Arabia liquidated $89 billion. The exodus is becoming coordinated. As foreign institutions liquidate American assets, demand collapses. Falling demand means falling prices. Falling prices trigger more liquidation. More liquidation accelerates the decline. It becomes a feedback loop that feeds on itself until the system breaks completely. The Federal Reserve will try to intervene. They'll restart quantitative easing. They'll buy treasuries to prop up bond prices. They'll purchase ETFs to support stock markets. But their intervention will trigger currency debasement. Dollar purchasing power will collapse. Inflation will explode. They'll choose hyperinflation over deflationary collapse. Either outcome destroys your savings. If they let markets fall, your stocks and bonds become worthless. If they print money to stop the fall, your dollars become worthless. There's no scenario where keeping your wealth in the American financial system preserves purchasing power. BlackRock understands this. That's why they moved $2.1 trillion. That's why they're positioned in foreign assets, real commodities, and alternative currencies. They're not trying to preserve nominal wealth. They're trying to preserve purchasing power through the transition. The transition from American financial dominance to whatever comes next, from dollar hegemony to multipolar currency competition, from confidence in institutions to recognition of their fragility, from the illusion of stability to the reality of systemic breakdown. And here's the timeline. Based on BlackRock's liquidation pace and institutional behavior patterns from previous crises, the breaking point approaches rapidly, not years from now, not decades from now, months. The acceleration is visible in the data. Q1 2024, $289 billion liquidated. Q2 2024, $367 billion. Q3 2024, $421 billion. Q4 2024, $523 billion. Q1 2025 projected $687 billion. The pace doubles every 6 months. At this rate, BlackRock completes their liquidation by Q3 2025. Once they're fully positioned outside American assets, they have no incentive to maintain confidence in American markets. They can stop their public support, they can acknowledge their private assessment, they can trigger the crisis they've been preparing for. But here's where the story gets darker. BlackRock's $2.1 trillion move reveals the specific timeline of America's collapse. This isn't random liquidation. This follows a precise schedule that matches exactly what happened before every major financial empire fell. Look at their liquidation sequence. First, government bonds. $623 billion in treasuries sold over 18 months. Why start with government debt? Because that's the foundation. When you lose confidence in government's ability to pay, everything else becomes worthless. Rome started the same way. In 255 AD, wealthy Romans converted denarii into land and foreign assets. They didn't trust the emperor's ability to maintain silver content. Within 20 years, the denarius was 95% copper. The empire never recovered. Second, BlackRock liquidated corporate bonds. $89 billion in supposedly safe company debt. This reveals their assessment of American corporate health. If Apple, Microsoft, and Amazon can't service their debts in the coming crisis, what happens to everyone else? The mathematics are brutal. American corporations hold $13.7 trillion in total debt. That's 64% of GDP. Interest payments consume 23% of corporate earnings. If rates rise another 200 basis points, 40% of American companies become unprofitable overnight. That means bankruptcy, mass unemployment, social chaos. Third, they dumped equities. $847 billion in American stocks across every sector. This isn't sector rotation. This is system abandonment. They're treating the entire American stock market like a burning building. Fourth, they liquidated real estate. $412 billion in REITs and property investments. Real estate has been the foundation of American middle-class wealth for generations. Home ownership rates peaked at 69% in 2004. Today, it's 65% and falling. Home prices are 73% above 2019 levels, while median income rose only 12%. Here's what happens next. Phase 1, currency crisis. Foreign central banks follow BlackRock's lead. Bond auctions fail. Yields spike. The Federal Reserve prints money. The dollar collapses. Import prices explode. Gasoline hits $8 per gallon. Food costs double. Phase 2, credit crisis. Companies can't refinance bonds. Default rates spike from 2% to 15%. Banks stop lending. Credit cards get canceled. The economy grinds to a halt. Phase 3, market collapse. Stocks fall 60 to 80%. Real estate drops 50-70%. Wealth destruction reaches levels not seen since 1929. Phase 4, social breakdown. Mass unemployment. Bank runs. Food shortages. Civil unrest. The social fabric tears apart. BlackRock is positioned for all of this. Their foreign assets will benefit from dollar collapse. Their commodities will explode during currency crisis. They position to profit from America's destruction while encouraging you to stay invested. The numbers are staggering. In 2024, BlackRock liquidated $1.7 trillion in American assets, while retail investors added $1.3 trillion to domestic funds. They're selling what you're buying. They're using their information advantage to transfer wealth upward. But here's the part that reveals just how cynical this operation really is. While BlackRock was liquidating American positions, they were simultaneously launching new products marketed to retail investors. ETFs focused on American growth, mutual funds emphasizing domestic value, target date funds assuming American market returns. In March 2024, while liquidating $127 billion in Treasury bonds, they launched the American Opportunity Fund, marketed to 401k participants. The marketing materials promised exposure to America's most dynamic growth sectors. Pure propaganda. They were selling you what they were dumping. In July 2024, while dumping $312 billion in domestic stocks, they introduced USA Growth ETF with advertising campaigns targeting millennial investors, television commercials during prime time, social media campaigns on Instagram and TikTok, all encouraging young people to buy American stocks, while BlackRock was liquidating the exact same positions. In October 2024, while liquidating $178 billion in real estate, they created American Property Income Fund sold through financial advisors to retirees. The pitch was simple: secure income from America's strongest real estate markets. Meanwhile, they were running from American real estate like it was radioactive waste. This isn't just moving money. This is creating bag holders. This is manufacturing demand for assets they're desperately trying to sell. This is using their marketing machine to transfer risk from sophisticated institutional investors to unsophisticated retail investors, from themselves to you. The timing isn't coincidental. It's coordinated. Every product launch corresponds exactly with a major liquidation event. They're selling what you're buying. They're exiting what you're entering. They're using their information advantage to systematically transfer wealth from the uninformed to the informed, from the trusting to the cynical, from you to them. And it's accelerating. In Q1 2025, BlackRock has already liquidated $127 billion in American positions, while their retail products have attracted $89 billion in new investments. They're liquidating faster than their marketing, which means they're running out of time to complete the wealth transfer. The smart money's already gone. The dumb money doesn't know it yet. The transition happens when the dumb money realizes what the smart money already knows. That moment approaches with mathematical precision. Your financial advisor won't tell you this because they don't understand institutional flows. They see the marketing materials. They attend the product presentations. They believe the public statements. They don't have access to the internal trading data that reveals what BlackRock is really doing with client money. Your 401k administrator won't warn you because they're focused on asset gathering, not asset protection. Their business model depends on keeping money flowing into their platform. More assets under management means higher fees. They make money whether your account goes up or down. They have no incentive to warn you about institutional liquidation. Your bank won't explain the risks because they're taking the same risks with depositor money. Regional banks hold $2.7 trillion in commercial real estate loans. When property values collapse, those banks become insolvent. When banks fail, deposits disappear. The FDIC has $128 billion to cover $18 trillion in insured deposits. That's 0.7%. When the crisis hits, your deposits aren't protected. The entire financial services industry is designed to keep you invested in a system that sophisticated institutions are systematically abandoning. They make money from your participation, not your performance. They profit from your trust, not your returns. They benefit from your ignorance, not your understanding. BlackRock manages money for pension funds, sovereign wealth funds, central banks, family offices, endowments, the most sophisticated institutional investors on earth. These entities have access to information, analysis, and expertise that individual investors will never possess. When they move $2.1 trillion out of American assets, it's not a mistake. It's not an overreaction. It's not temporary positioning. It's the institutional recognition that the American financial system is entering terminal decline, that the dollar's purchasing power will be destroyed, that asset prices will collapse, that the middle class will be wiped out, that everything you've been told about long-term investing and staying the course is propaganda designed to keep you invested in a system that's being systematically liquidated by the people who control it. But here's what makes this moment different from previous financial crises: scale. In 2008, total losses were $2.8 trillion globally. Today, global debt exceeds $300 trillion. The system is more leveraged, more fragile, more dependent on confidence than ever. When BlackRock triggers the next crisis, there won't be a rescue. The Federal Reserve can't